I am Abhishek. I am here to welcome you all for the study circle meeting on budget key analysis being conducted by Krishna sir. I would like to hand over the stage to the Krishna sir to continue the session. Have a good learning.
Good evening everyone. Today we are here to discuss the Union Budget 2026, specifically the impact on direct and indirect taxes. So this will not be a broad budget discussion. This will be specifically only on the changes in the direct and indirect tax laws. Okay. So firstly, what is the broad tax policy direction? So this budget specifically there is no much structural reform or rate changes. It is only technology-led compliance, litigation and penalty rationalization. So as previous budgets, there was changes in the tax rates, but in this one there is no tax rate changes. It is only more to do with the compliance side of things. So not much tax benefits which we were hoping for individuals, only the tax compliance changes. Okay. The structural and compliance reforms introduced in this are: the Income Tax Act 1961 has been replaced by the new Income Tax Act 2025 effective from 1st April 2026. So all the section changes will be effective from 1st April 2026. So please be careful while quoting the old section numbers in the new tax regime. Okay. Next, the tax computation framework simplified, ICDS rationalized. What does this mean? So while doing the tax computation, there was always a difference between the taxable income and the accounting income. This was because of the ICDS. So as per ICDS, there was a different recognition criteria for income and such other things. But the same has been proposed to be uniform and structurized by the new budget. So all the income, accounting income and the computed income, taxable income will be the same moving forward. But this does not mean that the ICDS are discontinued. The same will continue to apply, but the income computed under both will be the same going forward. Okay. Next, assessment and penalty proceedings streamlined. So previously there was different assessment proceedings and simultaneously parallelly there were different penalty proceedings. Both have been now put together and the same will continue seamlessly. So there is no separate assessment and penalty proceedings. All will be done at the same time. Next, the greater reliance on faceless and system-driven processes. Previously, most of the things were on the assessment officer basis. So we had to first approach the officer and based on their reading of the situation, certain things would be allowed or disallowed. But moving forward, most of them will be now faceless. Although the same has been introduced previously, but now the framework has been introduced to make it actually faceless and bring it to the actual workings. Next, a major change, especially related to tax audits. So the PF ESI deduction aligned with return due date. So previously what used to happen was, even though the employee portion of the ESI and PF were paid within the due date of return filing, the same would be disallowed. But the same has been changed, and now if the same is filed within the due date of filing return, it will be allowed. So no disallowance. So the employer portion and employee portion will be treated the same. There is no different. There is also changes in the ITR due dates. So previously we used to file based on whether the assessee is liable for audit or not. But now the same has been changed. So it is now more to do with the ITR file forms the assessee is filing. So if the assessee falls under ITR 1 and ITR 2, so he does not have any business income. So he will have the due date of 31st July. And if he has income from business or profession, he is falling under ITR 3. Still not audit case, but he is filing ITR 3 and ITR 4. For them, an additional month is given to file that ITR. So 31st August. Audit cases, there is no change. The same ITRs will be filed till 31st October. And for transfer pricing, the same will be 30th November. Belated returns, as applicable, it is 31st December. But the revised return, there is a change. So previously, revised return, the due date was filing was 31st December. Now the same has been extended up to 31st March. Moving on. Now, penalty realization and voluntary compliance. So, Previously, updated return was not allowed to be filed if there was a reassessment proceedings. But now the same has been changed to include reassessment proceeding, but the same is restricted. It is restricted based on the initial stages. So if just the notice has been served that you have some income which is missed out, you can file an updated return and declare your income. But if the proceedings have been carried forward and they have asked you for any documents or the final assessment is going on, then you cannot file the same. So it is based on the stage of the reassessment proceedings. Okay. Next, no penalty under section 270 if tax and interest paid on updated return. Previously, if you filed updated return including tax and interest, there would be penalty also, but the same has been done away with. Next, no interest on penalty amount during pendency of appeal up to first appellate authority. So if you filed an appeal, the interest would not stop then. What we do is, until the appeal was resolved, the whole time the interest would be calculated. But now what happens is, after the appeal is filed until the final decision is given, that portion, the interest will not be calculated. So depending on the outcome of the appeal, the interest will be calculated. Okay. And next, fixed and proportionate audit penalty framework introduced. So previously what used to happen is, if the tax audit report was not filed within the due date, the penalty was based on the turnover of 0.5% to a limit of 1,50,000. Now the same has been done away with and a proposed change has been introduced which says that it will be based on the number of days of delay. So if it is within 30 days of delay, the penalty is fixed at 75,000 irrespective of turnover. If the same is after 30 days, the penalty is 1,50,000. Next, the changes in TDS. So in TDS, manpower supply has been specifically brought under the purview of contract payment. Previously, there used to be a debate as to whether manpower supply is to be treated under contract or whether it is to be treated under 194J professional service. But now the same has been given with explicit clarification that whatever service given as manpower will be treated as contract service and it will be based on the status of the party providing the service. So 1% for individual HUF and 2% for other. Okay. And next, lower nil TDS certificates fully automated. Previously, you had to apply to the assessing officer and provide the documents to get a lower or nil fully now the same has been fully automated and you have to just file the thing online and it will be streamlined for small cases. For larger cases, there still might be a case of you have to go to the AO for approval. Next, digital declaration and compliance simplification. For non-deduction, first you had to provide the forms 15G and 15H individually to each and every person who is responsible for deducting TDS. Now the same has been done away with. What will happen is, you have to file digitally form 15G and 15H and the same will be distributed to all the key parties who will deduct TDS. Additionally, the depositories are also brought into the purview. So if you have any securities, you can provide a non-deduction certificate to the depositories and the same will be enough. You don't have to provide non-deduction certificate to individual companies. Depositories will circulate the same to all. Okay, now the next, TCS changes. Here, TCS on overdues package reduced to 2%. So previously, the same was 5% and the same, there is no threshold. So whatever amount was paid, 5% was to be deducted and paid to the government at the start of that itself, and afterwards you had to take the refund. But now it has been reduced to 2% to reduce the tax burden, upfront tax burden. Okay. Next, tax relief for educational and medical remittance. Previously, what was the case was, it was 5% of deduction. Now the same is reduced to 2% and it is LRS limit. So the LRS limit is 10 lakhs. So any amount paid above 10 lakhs, the same TCS will be applicable at the rate of 2%. Okay. And TCS on alcohol, scrap, minerals and tender leaves. Previously, tender leaves were taxed at 5%, alcohol and scrap were taxed at 1%. Now, to rationalize all of them, a unified rate of 2% is being proposed. So there is no confusion. All the TCS compliance will be at 2%. But for these specific goods, any other TCS applicable will still be applicable at the old rate of 20% itself. So only these specific ones they have reduced to 2%. Okay. Now capital transactions and investment. So previously buyback was taxed in the hands of shareholders in income from other sources. So what used to happen is it would be taxed on gross basis. So the total amount received would be treated as dividend and would be taxed at slab rate. And whatever was your initial investment would be your capital loss. Now the same has been done away with and it is brought into the purview of capital gains. So whatever the gain on the sale buyback of shares, it will be taxed as capital gain and it will be at the 12.5% or 20% rate based on the period of holding. But for corporate promoters, the rate applicable is still 22% and 30% respectively. Next, no exemption on transfer of sovereign gold bonds if not subscribed at original issue. So the amount on redemption of sovereign gold bonds was previously exempt at maturity, but the same is now brought under the purview of taxation in the hands of the receiver if he is not originally subscribed to it. So if you buy the sovereign gold bonds in the secondary market, the same will be taxed although you have bought the bond and redeemed it at maturity. So redemption is not the criteria. When you bought the bond at original issue or from secondary market, that will determine whether it is taxable or not. Okay. Next, exemption for compulsory acquisition. The same is aligned with RFTC LAR Act. What happened was there was some discrepancies as to whether compulsory acquisition compensation received would be taxable or not. So certain sums received would be taxable and others not. So what government has done is it has unified the two, and whatever amount you receive under compulsory acquisition will be exempt. Okay, and this next one is a bit specific to what we do. So MAT rate reduced to 14% with restriction on MAT credit utilization. So previously the MAT rate applicable was 15% and there was no restriction on utilization. Now going forward, the rate has been reduced to 14% and no new MAT credit will be available. So whatever is the MAT credit available will be carried forward and you can utilize it to the extent of 25% of the tax. So suppose you have a tax liability of 1 lakh, that will be allowed to be set off only to the extent of 25,000. The remaining you have to still pay. So and no fresh MAT credit will be allowed. So whatever, if say the normal tax is lower than MAT, you will not get any further credit. It will take at final tax. Next, non-resident in cross-border transactions. So simplified TDS compliance for property purchase from non-residents. So previously, if you bought a property from a non-resident, you had to take a TAN number, get registered and file the return through that. But now the same has been simplified. Based on the PAN itself, you can file the return, receipt cum return challan, and the same will be validated. Next, safe harbor exemption regime for specified cross-border services and sectors. Safe harbor is already existing. What they have done is they have added specific services and sectors which will be further notified. And last, fast track advanced pricing agreements. So advanced pricing agreements used to take a lot of time and would be based on the AO you are assigned to. Now the same has been thought to be brought faster through the fast track advanced pricing agreements. Next, trusts, charities and cooperatives. The trust registration validation has been extended from 5 years to 10 years. But there is a small caveat. This will be only for the trust registered on or after 1st April 2026. So the trust already having registration will not automatically get the extension of 5 years to 10 years. So if you have got the registration in financial year 25-26, the same will not be extended to 10 years. It will be for 5 years, and when you go for renewal, the new one, it will come for 10 years. Okay. Next, no adverse consequences for incomplete charitable applications. Previously what used to happen, if you have made some errors, the application would be rejected. Now, and whatever you have income would become taxable. Now what they have done is they have done away with it, and they will provide an opportunity for the assessee to make the corrections and file the form. Deduction allowed for cooperatives supplying cattle feed and cotton seed. There is a specific section for those cooperatives who are supplying cattle feed and cotton seed for deductions. The same will be notified. So actually they have not notified how much is the deduction and what are the thresholds. The same will be notified, but they have specifically said cooperatives supplying cattle feed and cotton seed are going to be covered under this deduction. Next, inter-cooperative income deductible when distributed. So if you have income from any other cooperative, the same will be deductible when you make the distribution to the end users. So if you have 100 rupees and you have already distributed 30 rupees, only 70 rupees will be taxable. The 30 will not become taxable. So they have removed the double taxation here. Next, dividend exemption for notified national cooperative federations. They have not notified them yet, but they have made exemption for the same. Next, exemptions and reliefs. Interest awarded by Motor Accident Claims Tribunal is exempt. Previously, the same used to be taxable after a certain threshold limit and TDS will also be deductible on the same. But now, all the interest amount is exempt. Next, withdrawals from NSS account by senior and very senior citizens exempt. So, on the withdrawal by senior citizens, which is above the age of 60, and very senior citizen above the age of 80, the same will become exempt. They will not be taxed for it. Next, similar exemption for NPS Vatsalya account subject to limits. The NPS Vatsalya account is another variation of the NPS account where the account will be opened in the name of the minor and operated by the parent or the guardian. Now withdrawals from this same are subject to exemption, but there are specified limits. The limit have not yet been specified. Next, disability pension exempt from armed and paramilitary forces invalidated from service. So total amount of pension received by these will be exempted. Previously there was a dispute as to the amount of exemption. Now total amount is been exempted. Next, exemption for foreign sourced income of non-resident experts under notified schemes. So non-resident experts receiving foreign income which is not accrued or arised in India will be exempt. The income of non-resident experts accrued or arised in India will still be taxable. Only the income which is not accrued or arised in India will be exempt, and the specified schemes have not been notified yet. Next, this is one of the important slides, so please look into it. Now, foreign asset disclosure. So previously what we had to do is we had to disclose whatever the foreign income and assets we had, but failure to do so there would be large penalties. But what government has done is it has introduced a one-time 6-month disclosure window where the penalty will be lower and you can disclose your incomes and assets. So there are two categories, totally 3 categories, but 2 categories. Category A is income and assets up to 1 crore. So in this category, the tax rate applicable will be 30% tax and 30% penalty on that tax. So around 37% of tax you have to pay after disclosure. Next, category B, income and assets up to 5 crore. Here there is a fee of 1 lakh. So in category A there is tax and penalty. In category B there is only fee. And for others, no penalty for non-disclosure up to 20 lakhs. So if the amount is less than 20 lakhs, there is no penalty, but the asset should be other than immovable property. If it is immovable property, it will still be considered. Okay? And for all the 3, there is immunity from prosecution under specified conditions. Specified conditions are the disclosure to be made, the tax and penalty to be paid, and it should be the total amount to be disclosed. Next, litigation, penalty and prosecution. Previously, if you were to go for appeals, the amount of tax to be pre-deposited was 20%. Now the same has been reduced to 10%. The conditional immunity from penalty and prosecution extended to specified misreporting cases. So previously, misreporting cases were not brought under the same. Now they are brought. Tax on undisclosed income reduced to 30%. Previously, the same was 60% plus surcharge plus cess. So we had to pay additional tax. But now the same has been brought to a flat rate of 30%. So no surcharge and cess. Simple flat rate of 30% on undisclosed income. Penalty and prosecution linked to the tax amount involved. So if the tax amount is less than 10 lakhs, there is only fine. If the tax amount is between 10 lakhs and 50 lakhs, there is simple imprisonment up to 6 months and fine may be prescribed. And above 50 lakhs, simple imprisonment up to 2 years, and there will also be a fine. So it is based on the amount of tax. Next, procedural offences decriminalized. So if certain offences are decriminalized, the only civil litigation will be there, no criminal proceedings will take place. And lastly, the indirect tax amendments. So there aren't much amendments, only 4, but we'll cover them nonetheless. Firstly, post-supply discounts excluded from taxable value. So previously, if you had to reduce the discount from taxable value, there had to be a previous agreement at the time of sale, and the other conditions had to be met. But now what they are saying is, even if there is no pre-agreement, post-supply discounts will be excluded from taxable value. The same will be done when there is a valid credit note and the ITC is reversed by the opposing party. Next, credit note expressly permitted for post-supply discounts and deficiencies. So related to the first one, now you can raise a credit note for the same. And next, 90% provisional refund extended to zero rated supplies and inverted duty cases. Previously, these were not covered under the 90% provisional. Now they have been added so that as soon as you file, 90% provisional refund will be granted, and the remaining after the refund application is done. And lastly, shift of place of supply for intermediary service to recipient location. Previously, for intermediate services, the place of supply was the place of supplier, not of the recipient. Now the same has been changed to give that wherever the intermediary service is being received will become the place of supply. Lastly, in conclusion, this budget aims to simplify direct and indirect taxes, lower litigation and reduce penal exposure, greater certainty to rationalization, and increase automation and system-driven compliance. Thank you.
I would like to thank to Krishna sir for wonderful session taken today, and also thanks to all partners and all articles and all staff members for attending the sessions. Thank you.